us in healthcare, it looks like, the good quality names in this space are once again kind of top of the pops. I'll be very cautious, though, how a lot of these stocks have actually run overextended valuations. I know it's never a good time valuation, that is, to make a call to cut stocks, but we're just saying trim on portfolios. I mean, the Cochlears, the CSLs, they have definitely been overextended. And even for CSL, just briefly, I would say I'm very worried in the first half. I think there's cracks appearing in that name. I'll be definitely trimming positions if they overrate in any portfolio. That being said, as I said, Tom, they are core holdings for a lot of them. They're ballasts in the time of market uncertainty. We had, another North Korea launch a missile. Hopefully it's not nuclear. Today, there's geopolitical risk, but the market seems to look right past it. I mean, there's going to eventually be a time that the market's going to take these at heart, and you need those ballasts in any portfolio. But before I jump into that, I want to move into HealthScope. So I did attend the Investor Day yesterday, a 5-hour kind of fest, and you kind of kick the tires on their hospitals. And tell you the truth, when you tour a hospital, you don't want to go back there and tour it because you're normally coming in as a patient. So it's interesting, albeit I wouldn't recommend it for everybody. But the key takeaways here is they reiterated their guidance. Now it's not that great. It's for flat hospital growth. Now this is in a very challenging, I would say, operating environment where there's a lot of volatility and cost pressure. So I take it away that it was good to see them reiterate that guidance. I wasn't expecting them to change their guidance, but there was scuttlebutt in the market that they would. Given 6 weeks ago that their AGM, they did reiterate that guidance there. They did say that it was pleasing, the Q1 performance, which is good to hear for the first time as well. And their top line in the first half seemed to be trading above the market rates. That was also pleasing to hear. They're obviously talking about the challenging operating environment, as we all know. Very, very, very focused and very confident in costing out to drive efficiencies in this new, what they're calling a new world. And you guys know it's affordability issues we hear every day in the press. It's pretty much a beat up. So it's good to see them kind of pushing through via benchmarking and best practices across their whole entire 45 hospitals in their portfolio, really kicking the tires across all of those assets. Now, we wanted to really get a quantum for that. They were a little hesitant. They put it in terms of tens of millions of dollars of savings going into fiscal 19. They said they'll give us a broader update in the first half, so look for more color around the actual quantum of that number into fiscal 19, coming in the first half, 18 results, obviously. But the event really wasn't a trading update. These are not held for that reason. It was really to showcase their new Northern Beaches Hospital. This is a very impressive state-of-the-art facility, $840 million in this hospital over a 3-year period. It's still in the construction phase. That construction should finish, though, before Christmas, and internal fit-outs before March of next year. This is the first foray for the company into a private-public partnership, or a PPP, where you're going to have both treated public as well as private patients in one integrated facility. So it's a very, very interesting facility, one of its only kind here in Australia. Ramsay has 5 PPPs, but those hospitals are normally retrofitted. So this is really the first prospectively actually integrated, constructed hospital of its kind here in Australia. Very, very impressive, as I said. More importantly, the management did talk about for the first time what the impact of this private hospital, Northern Beaches, hospital will be, and the P&L impact. So let me run you through the kind of key takeaways that I came out from that. Construction and commissioning, as I said, is on time and on budget. And as I said, this is a 3-year process, so it's really good to see that coming in actually quicker than they thought. So they have 68 contingency days that they said, which is good. This is a 450-bed hospital, 250 of which are public and 200 are private. They flip on the lights the 31st of October next year. So as I said, that's about 60-odd days, as I mentioned, quicker than what they're going to do. They're going to do it at the end of December next year, so it's good to see that coming online quicker. The return measures on this project is no different than the rest of their brownfield projects. Remember, those ROICs are over 15% on a 3 to 4 year view, so that's still along the lines of what they're targeting as well. The encatchment is really strong. This encatchment, 250,000 people live in this encatchment. Private health insurance is above 60%, hasn't really deviated or waned from that mark of late. That's above the national average, of course, and about 80% of the encatchment that have private health insurance actually leave the encatchment to get their healthcare services outside the hospital systems, because the current hospitals there don't give the quality of care to those patients. So this one will fill that void, which is good to see. They're saying that they have very strong interest from physicians. Physicians have actually been used as input for the design of this hospital, And interestingly enough, for the first time I heard that they're actually interviewing physicians for consulting suites. Now, normally that doesn't happen in the private system. Normally they just get all comers to come in. So for them to interviewing people, they said they have over 300 physicians that have expressed interest is very good because they're cherry picking their docs. These docs will come with patients and the hospital will be filled day one. And they're saying this is a big active, what did they say? Big active, high volume site, quote unquote. They're confident that the 250 bed on the public side will be filled very near term, and they're forecasting profitability first year. I think that's an impressive feat for the market because we didn't really have that in our numbers. And I don't think anyone on the street would have that in their numbers, profitability in year one. However, they're saying the top line revenue over 300 million, likely to come up 3 to 4 years into their ramp with their margins, EBITDA margins roughly the same as the group margins, or roughly 17.5%. So that's quite good. They're talking about their capital payment. Now, remember that this project is fully funded by Healthscope, but the New South Wales state government will give them a check for $435 million upon completion and commissioning of this hospital. Now, the market's always been concerned with the balance sheet flexibility because net debt to EBITDA currently stands at 2.7, that will ramp to around 4 times. That's pretty tight for this company. However, that payment they're saying they should get on the balance sheet by the end of next year, so it's December next year, which is good because I believe that will alleviate the market's concern that the balance sheet is under stress or strain here. So I really came away with a better appreciation for this actually project. I'm a little more optimistic, I would say, of the company's future prospects. That being said, I can feel management's general sense of urgency for cost out and efficiencies, running a ruler, as I said, across all our 45 assets. Utilization, however, in this environment remains difficult. It's soft, it's sluggish. Affordability comes up every day, as I said. I'm still happy to maintain my ad rating in this name on medium longer term view. However, I would caution you that there's a lot of execution risk in this story. I was sitting outside the hospital looking at the big pile of dirt thinking, Jesus, there's a lot to be done yet for this facility to kick on, get the patients, get the physicians on board, and have them make profit. They're targeting the first year. Will the market give them the benefit of the doubt? The people I talked to, and there's probably 30 or 40 people at this event, it was well attended, not so convinced because, let's face it, Healthscope has kind of struggled with their greenfield projects, and this is one of those projects. So they're a little more hesitant. They want to see it reflected in the numbers. But I think at the current trading levels, it's trading on a forward multiple roughly in line with the market. Around 18 times. I think that's reasonable for what it is, but like I said, for active traders out there, I'd say be a little light in your toes near term. Good to see them reiterate their guidance. Good to see second half momentum if they can get it, but execution risk with the Northern Beaches is still on the table, even though I do like the story still. Just quickly further across our universe, I would say still happy to back Ansell at these levels. Its run-up has worked really well, cyclical recovery. It's a pure play industrial name, shouldn't be in the healthcare space, but it's putting up double-digit growth. It's trading at a market multiple. Still happy to own that. Momentum should stay with ResMed. This is a medical device company, obviously. The market's really getting a feel and actually understanding that this actually is melding, or let's say transforming, into more of a leader in cloud-based connectivity and big data analytics. And this is really driving patient-based outcomes and lowering the cost of medical care across the whole continuum in our space, which is good to see. So I still am backing ResMed at these levels. High conviction call on ResMed. Finally, CSL, as I said before, Tom, I'll be trimming some of that. I just think it's run too hard, too fast. In the first half, I think it's going to be a little dicey. I'm a little more hesitant on that name, always kind of trimming positions on strength. I think with that, I spoke too long as normal. I'll pass it up to Scotty to talk about the IVF players, and I think he has some few trading ideas for us.
Yeah, thanks, Derek. As Tom mentioned, the healthcare sector has been very strong this year. However, there have been a couple of laggards in that space, and they are the IVF players. So we've been sitting with neutral recommendations on the space for the last 2 years. But last night we did move to an ad on both Virtus and Monash. So just following some commentary from their AGM, both companies are saying that the long-term cycle growth is returning. So that's around 3%. And that has been supported by some recent Medicare data. And if we look back over the last 6 months, we can see cycle data running about 5.5%. Some of that growth is coming from primary healthcare, which have successfully opened a low-cost operation in Sydney, Melbourne and Brisbane. But generally, both companies are saying that the long-term growth of around 3% seems to be back on track, which is very comforting for us. If we look at the individual companies, Monash last Friday had a massive downgrade, 20% on their first half. They called out the loss of a key doctor that was well known by the market. The new CEO has just joined the company, so he's had 8 days in the seat. My view is that they've set the bar pretty low with the view to achieving better results over that period. If we look at consensus numbers, it's trading on a PE of about 11 times and EPS growth around about 10% coming through for Monash. So happy to move that back up to an add. Virtus, similar story there. They had a very disappointing FY17. Talking to the company yesterday, their business is very much stabilised. They've called out a number of cost savings for FY18, which they say are on track. Also looking at consensus numbers for FY18, which they're very comfortable with. We have the stock trading on a P of around 13 times and EPS growth of around 10%. So on valuation metrics and stability in the market, we're happy to move back to add on both those names. In other news this morning, there was a takeover bid announced by the 4th and 5th largest radiology practices, so Integral Diagnostics and Capital Health getting together. So Capital Health is bidding for IDX. Pretty healthy premium. Looks like most of the major shareholders are supporting the deal. Conceptually, it does make sense. There'll be some good synergies coming through for both those groups. So have a look at that if you've got clients in either Capital Health or IDX. Just in terms of a couple of trading ideas, we did put ImpediMed into the Active Opportunities Fund a couple of weeks ago. That's working pretty well for us. 2 key catalysts that we're expecting. Product approval for their next generation device for heart failure is expected before Christmas. And they've also got some key study results coming out on their lymphedema work. Again, that's expected before Christmas. So happy to continue to put ImpediMed in front of clients. A couple of other names I'll just draw to your attention. Nanosonics, back at the bottom end of its trading range. They're investing heavily in new product development over the next couple of years. See this as a good long-term story, so around 260, happy to buy that for clients. Not all of our recommendations work for us. So one I will point out is Admetus. We think that business is going to struggle. So happy to take clients right out of that stock. There has been a little bit of price strength, so just happy to reduce holdings in that name.